this trade right here, a massive 18% gain, was all possible because of a simple yet super powerful tool, candlestick patterns. Today guys, we will talk about candlestick patterns, a concept that is often overlooked by beginners but highly valued by professional traders. In this video I will talk about what a candlestick pattern is, and we will also look at 5 candlestick patterns, 4 of which I haven't really seen anyone here on YouTube teach. So now guys, without further ado, let's dive into one of the oldest techniques of trading, Japanese candlestick patterns. Now let's embark on a little journey through time and space, all the way back to the 17th century Japan. Long before Wall Street existed, and a time when Europe was just beginning to explore the concept of joint stock companies, a legendary rice trader named Munisha Oma was developing a unique method to predict future rice prices. This method was the birth of what we now know as candlestick patterns. Homa realized that the emotions of traders, their fear, excitement and greed, played a significant role in pricing of rice contracts. He created a visual tool that not only included the day's opening and closing prices of rice contracts, but also its highest and lowest points. This tool, resembling the shape of a candlestick, was instrumental in predicting future price movements based on market sentiment. This right here are 2 different types of candlesticks, and each candlestick represents a specific period of time. Every candlestick can represent, for example, 1 day, 1 week, 1 hour, or even a minute. For the sake of this example, let's think of these candles as daily candles, so every candlestick represents 1 day. The body of the candlestick represents where the session opened and where the session closed. So for this green candlestick, the day started at a price down here, but the day ended at a price all the way up here. The green color represents that during the day, the price went up. The opposite is true for the red candlestick. Here, the day opened all the way up here and the price closed all the way down here. The red color represents that during the day or during the session, the price went down. But as you can see, we also have lines that goes both above and below the candlestick patterns. These thin lines represents the lowest point and the highest point during the session. So for this green candle, it opened here, but during the session, the price went down to a lowest point all the way down here, and the price went up to a highest point all the way up here before the candle closed at this point. The opposite is true for the red candle. During the day, the price actually reached a point all the way up here, but the price fell all the way down to a lowest point down here, but the session or the day closed at this point. These thin lines are called either wicks or shadows. The first candlestick we will talk about today is the Hammer Candlestick Pattern, and one very great thing about this pattern is that it occurs very often in markets. The Hammer pattern is a bullish reversal pattern, meaning that it indicates a reversal of the price to the upside. To find this pattern, you need to look out for a candlestick with a small real body and a long lower wick. The candlestick wick of the hammer should be at least twice as long as the real body. The candlestick can be either a green candle or a red candle, but the green candle is a bit more bullish. It is a bit stronger and more effective than the red one, but even if we have a red candle, it still counts as a hammer. So for the hammer, the price opens here, but during the session, for example a day, the bears managed to push the price all the way down here. But during the candle, we can also see that the bulls are taking control, and before the candle closes, the bulls actually manage to push the price all the way here. It indicates that the bulls are taking control and that the price might reverse. This right here is the example we looked at in the beginning of the video. Right now we're looking at a Bitcoin chart, and every candlestick on this chart represents 1 day. One very important aspect about the hammer candlestick is that before the hammer occurs, we need to see a downtrend. The hammer candle is most effective if it appears right after a downtrend. As you can see in this example, the hammer appeared after a strong movement here towards the downside. The entry for this pattern is usually at the candle close of the hammer, or some traders wait for a confirmation candle. So they wait for one more bullish candle after the pattern before they enter the trade. The stop loss you usually set below the lowest point of the hammer, so just slightly below the lower wick. You set your stop loss around there, and your profit target will depend on your strategy. You can use, for example, support and resistance levels or other methods to take your target. The next candlestick pattern I want to talk about is the Rickshaw Man, and this is a candlestick that is not talked about a lot. The Rickshaw Man is a type of doji candle, and a doji candle is basically a candlestick where the real body of the candle, so imagine this is a candlestick right here, the real body of the candle is pretty much non-existent. So a doji candle is a candlestick that looks something like this, meaning that the candle opens right here. During the day, it reaches a lowest point all the way down here and a highest point all the way up here. The Rickshaw Man is a special type of doji candle. It is a doji candle that has a long upper wick and a long lower wick. So it is basically a doji candle, but a doji candle that has two long shadows. And you may of course wonder, what does the Rickshaw Man tell us? Why is it an important pattern to spot in the markets? It is a pattern that indicates what we call market indecision, and that basically means that neither the bulls or the bears are in full control of the market. So while the Rickshaw Man doesn't give us any clear signal, what it can indicate is that a trend might be coming to an end. If you're seeing a strong uptrend, imagine these as green strong candles, and then suddenly a Rickshaw Man candle appears. This is not a candle that indicates that the market will reverse, but rather it's an indication that the steam of the market or the momentum of the market might be coming to an end. So for example, a rickshaw pattern can many times be the beginning of a sideways movement instead of continuation of the trend. So you can basically see this candlestick pattern as a sort of warning sign that the steam is running out. In general, the longer the shadows or the wicks, so the longer the upper and lower shadow are for the Rickshaw Man, the stronger this pattern is. One important lesson from the Rickshaw Man is that not all candlestick patterns are buy or sell signals. Candlestick patterns tells us the story and psychology behind the market movements, and markets are not always in an uptrend or downtrend. Many times the market is just trading sideways. The next candlestick pattern I want to talk about is the Momentum Candlestick. In simple terms, a momentum candlestick is a candlestick that is much larger than the preceding price action. We want the real body of the candle to be at least 2 times larger than the previous candles, and preferably we want to see even 3 times or 4 times larger than the previous candles. The momentum candle tells us that we're seeing a strong shift in how the price behaves. When we're talking about a bullish or green momentum candle, this one indicates that we are seeing a strong imbalance between the buying and selling pressure in the market. In this case, the buying pressure are much stronger than the selling pressure. The momentum candle is a strong candle because it can indicate the beginning of a new trend. Think of it like this: when we have a choppy market or a market that goes sideways, which the crypto market did here for a while, and then suddenly we see a strong momentum candle. One of the reasons that make the momentum candle so strong is because all the traders that are shorting the market in this range, or at least most of the traders here, they will not exit the short until their stop loss is hit. Let's for example say that someone shorted the market all the way back here and set a pretty conservative stop loss. They might have a position that looks something like this. One nice thing about momentum candles that completely changes the direction of the preceding price movements is that it is likely to liquidate many short positions. And when we liquidate people that are shorting or betting against the market, this will actually add to the buying pressure. As you can see, in this particular case, this strong momentum candle was the beginning of a new trend towards the upside. The same thing also applies for the bearish momentum candle, and this is an extreme example right here. You can see we had a sideways market with very small candles here, and then suddenly we're seeing a strong shift in how the price action behaves. This massive red candle indicates a strong imbalance between the selling pressure and the buying pressure. This not only leads to stop losses being hit, but it also leads to market emotions such as extreme fear. And as you can see in this example, this strong momentum to the downside was just the beginning of a crash. The next pattern we will look at is called the rising three methods. And as you can see, this is a larger pattern consisting of 5 candlesticks. The first candle is a large green candle, and this one should come after an uptrend. This is very important because this is what we call a continuation pattern. A continuation pattern, when we're talking about a bullish trend, is a pattern that comes after an uptrend, then the pattern appears, and the goal of this pattern is to continue the trend in the same direction. So the first thing you're looking out for here is a large green pattern coming after an uptrend. After this strong green candle, we need to look out for not only 1, not only 2, but 3 red candles in a row. And it's important that all of these 3 red candles need to be within the price action of the first green candle. So as you can see, all of these 3 red candles are within the range of the first green candle. The final candle of this pattern is another green candle, and the important thing here is that this green candle need to close above the close of the first candle. So remember, this right here is where the first candle closes, and it's important that the 5th candle of this pattern closes above this point right here. You can think of this pattern as a rest in the uptrend. This small red candle reflects a period of consolidation before the buyers take control once again and the trend continues towards the upside. Here you can see an example of the rising three methods on the Bitcoin chart. We're looking at a daily time frame, so every candlestick here is 1 day. And as you can see here, we do have an uptrend, right? We have an uptrend. This green candle right here is the start of the rising three methods. We have a strong green candle which comes after an uptrend. After this, we have 3 red candles that are trading within the green candle, right? You can see all of these 3 red candles are trading within. Then we have the final green candle that clearly closes above. This one clearly closes above the first candle of the pattern, and this is where our rising three methods is confirmed. And as you can see, this candle right here was the beginning of a continuation of the trend. The final pattern we will take a look at today is the Morning Star pattern. And the Morning Star is a pattern that appears after a downtrend. And the goal of this pattern is to act as a reversal pattern to the upside. Now let's take a look at what candles does this pattern consist of. Well, the first candle, candle number 1, is a red candle, and this is basically just a candle that continues the trend towards the downside. The second candle of the Morning Star is a small candle. This one can be either red or green, but preferably we want a green candle. And the important thing here is, and I hope you can see, is that we need a gap here between the real bodies of the red candle and the green candle. So we need to have some space between the real bodies here in order for this to be a real Morning Star. After this gap down candle, we want to see a strong green candle, and preferably we want this candle to close at least above the 50% mark, right? So close above 50%, but preferably we do want this candle to close even higher, preferably close or even above the previous red one. When the green candle closes above this 50% mark, that is our signal, and this candle is confirmed. The Morning Star pattern indicates a potential reversal. We can think of it as this. The red candle signals that the downtrend and the bears are still having control. However, this green candle is giving some kind of indication that the bears are losing steam and that the trend might be weakening. This next strong green candle confirms that the bulls are starting to take control of the market once again and indicates a potential reversal to the upside. The entry point of this pattern is usually at the close of the green candle. Some traders even wait for one more confirmation candle, so they enter at the close of a next green candle, but many traders also enter at the close of this candle right here. So this is our entry point. As for our stop loss level, the most common way to set your stop loss is to set your stop just below the lowest point of the second candle. Remember guys, that even though all of these patterns we have been talking about in this video are considered useful and reliable patterns, nothing in trading is certain. So for all of these patterns, and this is true for technical analysis in general, I highly recommend that you use this pattern together with other technical variables, such as for example, support and resistance, indicators, momentum divergence, chart patterns, and so on and so on. Not all the time, but most of the time in technical analysis we want multiple variables to confirm our trade. But yeah guys, this is pretty much it for this video. I really hope you enjoyed this one. If you're interested in more technical analysis education, please don't hesitate to subscribe and hit that notification bell. And also guys, if you want to learn more about trading and technical analysis, make sure to check out the trading playlist I will pop up on the screen right now.